It's Wednesday. It's Truth or Skepticism. I'm Tom Sosnoff. He's Dylan Radigan. Mr. Radigan, how are you?
Good, getting ready to nationalize all these banks. I mean, I figure if we're going to allow the executives to compensate themselves in the tens of millions of dollars to do really whatever they want, they can do a good job managing the bank, or they can do a bad job managing the bank. They can bankrupt the bank, or they can make the bank profitable. Doesn't really matter, because the taxpayer is going to be there no matter what happens. We might as well give the taxpayer total possession of the entire banking system instead of pretending we have capitalism and just allowing the bankers to keep all the upside and transfer all the downside, which is something we should have nationalized the banks in 2008 and clawed back all the money. And this is just another opportunity. So hopefully that's what's going to happen here.
Wow. So we're on to the, I mean, in a crazy way, it's very well said. There is, they take no downside risk. They have all upside potential, and they lead a good life until they end up in jail and or on the street.
But they don't even end up in jail or on the street because there's no clawbacks. I mean, Bruce Wasserstein, when he was running Lazard in 2008, I had a lunch with him in the middle of the like at the sort of peak of the financial crisis. Yeah. And I said, "What do you think, Bruce? You know?" And he said, "Listen, the board of directors and the CEOs of these banks are really paid to do, basically two things. One is sales, and two is risk management. They decide the risk aperture of the bank. And if the only benefit of adding risk is you get more money until the bank blows up, everybody will add risk to get more money until the bank blows up. And if when the bank blows up, there's no clawback of the previous 5, 10, 15 years of multi-million-dollar compensation for your theoretical risk management, which is a fraud because it's going to catch up with it, even blow up later, as it did in 08 or as it did at SVB. You claw back that money, and if you're going to take government intervention for your balance sheet, then the government needs to own the totality of the equity. And that seemed logical to me.
Well, first of all, a couple things on that. First, isn't every CEO, every good CEO, just a salesperson anyway?
Sales and risk management, right?
Well, most CEOs are sales. Risk management. The reason that banks are interesting from a risk management perspective is because they really don't have a lot of sources of revenue. I mean, they can't. There's not much they can do. So the reason that banks have this risk component to them is that all a CEO for the bank can do is just extend duration to extend duration. If it's on deposits, they can extend duration. If it's on loans, they can extend risk. So extending risk is what happened in 2008, and extending duration is what happened in 2023. But those are the only decisions banks have to make. There is no other source of revenue, is there?
Well, no, because they can make it part of that, whether it's extending risk or extending duration. And I guess it's the same thing. It's how much leverage, right?
No. Extending risk means that you're taking either the collateralized
quality down.
Yeah, you're taking the credit quality or the collateralized asset down a couple of notches. Extending duration is completely different. Extending duration, you're accepting a deposit. You have absolutely no. I mean, you just took somebody's money. There is no credit risk. The risk is that you are trying to get a couple extra basis points, so you go out longer in the curve. Like, that's all it is. You give me $100 of your money, of Dylan Radigan's money, and I'm agreeing to paying you 10 basis points. You don't actually have the ability to ask or to know whether I'm using 12 basis point overnight money or 120 basis point 10-year money. Like, there's no way you know that.
Yeah, and I get all that, but I think the one thing, and I don't disagree, but I think the one thing you're leaving out is leverage. The CEO controls leverage. In other words, the degree to which there is a cushion to
Yeah.
endure
Okay. Fine.
shocks.
Fine. So we both agree that CEOs everywhere, their job is sales, and and
And risk management, where we can maybe have a dispute here, but
okay, whatever. And in the banking industry, there's a risk management component. But the whole thing is, if we were to say, okay, let's just take everything in house, we'll nationalize everything. The problem with that is then there would never be with zero competition. Okay, there would be no services. There'd be no incentive to create technology.
yeah, I don't disagree with that. But what we have now is a hostage taking situation where,
Yeah.
because you say, oh, well, there won't be, and you're like, oh, yeah, there wouldn't be these services. Wait, okay, fine. So therefore, what? My only choice is to let you do whatever you want until you blow up, and then you're going to take me hostage and say, either you bail me out, or this thing's going to spiral through the whole system, and everybody's going to get fired, and all the apocalypse is not, it's
So you have all these crazy people now saying, on the one hand, you have these people saying, well, let them, you should have let the depositors lose all their money, because then we would have taught them a lesson. And I'm like,
that to me is ridiculous, by the way.
Of course, it's absolutely ridiculous, but you wouldn't believe how many people and how many editorials and how many op-eds, that's what they're talking about. And they're like, well, if you don't like it, you have the 250K, you could just go to more banks. So I'm like, well, if you have 10 million.
Spoken like someone who's never had to manage a company or banking.
Of course. So if you have $10 million, you have to go to 40 banks. And if you have $10 billion, you have to go to 400 banks. I mean, it's the most ridiculous thing I've ever heard. Okay. So that's for complete morons, that one side. But then there's the other side. There's the Ken Griffith side, which basically said that, this is a challenge to, what do you call it? Moral integrity or
moral hazard.
Moral hazard. Right.
No risk. Which is what I just described.
Yeah, exactly. And the problem with that is then you're basically, if that's the case, then just like you said on Sunday night, you're just turning the entire banking system over to 4 banks that you might as well nationalize everything.
Right. Well, I would say that the subtle, if you really want it, let's say you're like, okay, we don't want to nationalize the banks for a variety of reasons, both, innovation stifling and culturally antithetical, right, to the ethos of the America. Okay. You also don't want to have a situation what we have now, which is because now on Sunday night, I said you have 2 classes of banks, right? You have the big 4 who are too big to fail certified, and you have everybody else. What we have now is 3 classes of banks, because you have the big 4, which are guaranteed. Then you have the 2 failed banks, Signature and SVB, which are also too big to fail now to prevent contagion, ostensibly. So now you have these little banks that are in the same dynamic. And they have a 3rd class of banks, which is everybody else. So now you're either one of the first small banks to fail, which means you get special guarantees because with contagion risk, or you're one of the jumbo banks where you've been certified since 2008, you're too big to fail because you're too big. And now you have a 3rd class of banks, which is everybody, Western Alliance, First Republic, go down the list, right? Which is why I think part of the reason those things are getting annihilated. Anyway, my point is, how do you correct for moral hazard without either nationalizing or forcing the depositors to be the risk manager, which is the issue with letting the depositors lose their money is it presupposes that the depositor is supposed to be the risk manager for the bank, which is nuts. Because if somebody's already trying to run a bagel shop or a trading shop,
of course.
And so then how do you correct for moral hazard? And then that's where, it goes back to a lot of the things that I was saying in 2008 and 9, which is, well, you correct for moral hazard by clawing back all of the assets of the management in the private. It's not about, are they going to wipe out the stockholders and the bondholders? And that's certainly a piece of a penalty for bad risk management, and I'm all in favor of it, but it doesn't speak to the amount of money that's extracted from these institutions in the 1 to 10 years prior to the blow up. And I would assert that if you actually had genuine absolute clawbacks available for at least the board and the CEO, that would be another moral hazard that would solve the Ken Griffin issue without having to lay the responsibility on the depositors.
Wouldn't just wouldn't restricting the amount of flexibility they have with not having to report mark to market or unrealized losses do the same thing? Because what that would do is essentially immediately change their balance sheet and their income statement, and what it would do is it would force valuations down. Because listen, banks are a very weird animal. They have essentially one source of revenue. I mean, it's just a spread. Like there's
a spread and a fee per service, we'll say. Fees.
Fine. Some banks have fees, right? Maybe a fee for service and a spread. That's it. You're managing a spread, and then you're managing your expenses. I mean, that's really all it is. And that's why there was a huge boom in challenger banks, because it made sense, to offer better technology, everything else. But anyway, that's neither there yet. So if you,
but let's go to your point, because you're making a point about changing so let's say we change the accounting rules.
Right.
Therefore what?
Well, you change the accounting rules, so automatically what happens is, so why did this happen to Silicon Bank? I mean, why to Silicon Valley Bank? And the answer is because their stock went from 300 to 800. And the only way that they could justify the revenue growth required to keep their stock between $500 and $800, they were all getting so full of themselves, was to generate a certain number of basis points on the spread. And that's what forced them. Do you think what incentive do you have to go out, 3, 5, 7, or 10 years? There's no incentive to go out longer duration unless that justifies your stock price. And you have to make that argument. That's all it is. So my argument would be, if you want to build a bank and you want to run a bank, what you have to do is you have to change the rules with respect to, what you can do with depositors' money and what you have to disclose. And then if you want to grow the valuation of that bank has to spend money on different things. Like they have to branch out. They have to be more innovative. They have to either, do deals, create other companies. They have to do all this different kinds of stuff like every other business does. Listen, brokerage firms are different than banks. Brokerage firms have 3 sources of revenue. Banks essentially have 1. Brokerage firms have 3. Other businesses have 1, 2, or 3 sources. They figure out other things. Amazon did it. Apple did it. Let some bank do it. I mean, the reason banks are so just god awful is that over time, the only way they've been able to figure out other sources of revenue is to basically, like Wells Fargo did, steal it. Citigroup did, steal it. JP Morgan did,
or defraud it in some way.
And JP Morgan to a certain extent did the same thing, and then or go out and do something incredibly stupid and just blow it all like Silicon Valley Bank did. Now, the 2 banks that got caught up in this mess, and let's not forget, Credit Suisse is just another disaster.
Right, but I feel like Credit Suisse is a totally freestanding. Of course. Years. Yeah, everybody's acting like, oh, it's the Bear Stearns, it's 2008. No, bullshit.
No, it's massive amounts of fraud and incompetence and
they had Archegos in there. I mean, they have so many different screwball.
Yeah. It's just complete mismanagement from top to bottom.
And the Saudis cut him off, and that was going to happen eventually anyway.
Same thing with Deutsche Bank. Same thing everywhere. Blah blah blah. Same money source.
This is not 2008-9 at all.
No. It's embarrassing. It's disgusting, and it's complete lack of understanding. It's pure ego and arrogance. It's everything else. But the 2 banks that got screwed were Silvergate and Signature, because unfortunately, in the world we live, banks like JP Morgan, they won't take blockchain customers. They won't take customers that are in the crypto business. And so a lot of these firms, and then they all justified it with, well, look what happened at FTX. See, we were smart. We didn't touch. They're toxic. We never touched them. But the problem is all the firms that are firms that innovate. Okay, they don't want anything to do with you until you're the size of Apple, or until you're some ridiculous amount of money. Until you can, they don't want your 5 million, your 10 million, your 20 million. That's why Silicon Valley Bank thrived, because they said, we'll take your $3 million friends and family round. We'll take your Series A, and that way we'll get your Series B and C and D. And they were smart about that. That part they got. JP Morgan says, go F yourself. We don't want your money. And Goldman Sachs, I have a story going back years when we built Thinkorswim. The first place we went to clear with, because we knew everybody there, was at Bear Stearns. And the first thing they said to us is, hey, come back in a couple of years when you grow up.
Yeah.
That's when I cursed them. At that moment, I cursed them and said, someday, you're going under. And some firm showed up on our doorstep and said, we want your business. And I'm like, fine, you got it. But that's a trust.
But I want to come back to the fundamental issue, which is bank management.
I understand, but I'm saying that Signature and Silvergate, they got caught up in an unfortunate situation where, and crypto firms the same thing. They had nowhere else to go. Nowhere to go. Nobody would take them. Like, we're invested in crypto firms now, and they call us up to say, can you make introductions for us? Because nobody will take our money. And they're just trying to make a deposit. It's insane. No,
but again, right now the incentives are still, especially now with what happened with the bailouts, which I because of the hostage taking structure, whether it was the hostage taking in '08 or the contagion hostage taking that happened a few days ago, whether there's a guarantee or not, as long as you have the leverage of contagion or too big to fail, you're always going to get bailed out, which means that why not take every crypto firm, or why not extend risk any way possible to get a bigger spread, right? And I guess so that's why I'm saying, well, how do you mitigate that without nationalizing? And my answer is, okay, clawbacks, all that compensation comes back. Like that there's basically the same way with your tax returns. There's a 7-year window or whatever it is where you have to keep your returns for an audit. Like if you run a bank and whatever your compensation was the last 7 years.
That's tough though, Dylan. That's really tough.
Well, isn't it tough to have the American taxpayer be the balance sheet for a bunch of millionaires that are extending risk and living on
I know, but the clawback doesn't work because nobody has that money.
They have assets. I mean, there's assets. There's federal assets.
That's not what. Okay, so
it's an incentive not.
No, it's not. No. So let's say this guy, Gary, whatever his name was.
We'll just call him Party Boy. Party Boy makes $10 million a year for the last.
Greg Beckers, I think it's Greg Beckers, whatever. The guy from Silicon Valley Bank. So they lose $20 billion. Okay, in duration. Let's whenever it is. Let's say they had to realize. I don't know what percent of it they have to realize. They had to realize $2 billion so far. So they realized $2 billion in losses. So you're going to take his $5 million house in Palo Alto. Who freaking cares?
It's not about, but no, the reason is it's an incentive. It's an incentive for him over the last 7 years to manage the bank differently, because he knows that if he winds it up a little too far and things get squirrely, yeah, he'll get bailed out and the deposit will get bailed out, but federal asset attachment will come and powder him.
So
I'm just looking for a deterrent to moral hazard on the Ken Griffin side.
So we should be like, this is the Israeli approach. We'll just, if your son's a terrorist, we take out your family. I'm just saying.
It's not. I understand I understand what you're saying, which is like, why is it his son's fault who's in college and all of a sudden he's got to drop out because the old man got jammed?
I'm just saying that, to me, that's more of a let's satisfy the public who wants to.
Then what's the deterrent?
I told you the solution
which is accounting revisions.
yes. The difference is that this is pretty simple. If they were forced to market, this is it. There is no problem. They would have been forced to cover a year and a half ago. I mean, that's all there is to it.
I mean, I don't that, and so I mean, listen, I don't have an issue with the accounting solution, and if that's the sort of least abusive way to solve it, why not? The issue with the politics of banking is the extremity of the entire thing makes something like that, which may be a rational solution, seem extremely unlikely. Because the politicians come out of the woodwork as they have the last few days, one way or the other, scoring points. Can I move through this to the application thereof? Because I was thinking about you as I was watching the 2-year. I think we were talking about the 2-year last week about this. And obviously the 2 years had a staggering move.
Yeah, sure is. Incredible.
Like unbelievable. Had to have been a good week for I remember you were saying
the yield curve. I was long the 2-year. I'm still long the 2-year. It was the biggest week ever for yield for the yield curve steepener. Yes, best ever.
So you have the yield, you have the 2-year situation, and then let's say you also have what I think is an inevitable credit contraction by way of all of the banks on the equity side and everything like. There's just no, and so I would posit that this is vastly more effective to reduce inflation and moderate the economic situation than any rate hike. In other words,
this is your rate hike.
That's my point.
Yeah, this is your rate hike.
This is a rate hike times 1,000.
Listen, I've been on top of a soapbox this entire week saying that the Fed, this is probably the Fed's finest moment in the last couple of years, was this past week, because they did exactly what they were supposed to do, which was stabilize the markets, provide integrity to the marketplace, and stop people from freaking out that everybody was going to lose all their money. Okay, that's it. And that's their job. Now, this move also made their next move with respect to interest rates a piece of cake, because if the 2-year goes any higher, they don't have to do a single thing. And if the 2-year sells back off, a couple of points by next Wednesday, they can go a quarter of a point. But before it was 50-50 to go 50 basis points or a quarter. Now it's 50-50 to go, nothing or a quarter. So the whole move itself already played the Fed's hand for them.
It's over. Like the Fed move is right. Yeah, I agree with. I mean, I totally agree. Yeah. I think that's a good thing, though. In other words,
It's a great thing.
Yeah.
It's also a great thing because for the first time in a long time, everybody can see what we're talking about when we say that. Like, we've been sitting here since I've known you, I've been saying the Fed doesn't set interest rates. The marketplace sets interest rates. The Fed just comes in and confirms it. That's all it is. But the Fed does have a purpose, which is in a time of crisis, they step in and they stabilize the markets, because you don't want your politicians doing it, because then everything becomes politicized, which is a really bad thing. Like, you don't want Biden, you don't want the whole administration making decisions about what happens with, this bank or that bank. Then everybody will be up in arms and saying, no, this is just all political, blah, blah, blah. It's another student loan thing. This is the perfect situation for the Fed to come in and say, hey, you know what? Nobody's going to lose any money. It's not our fault that we raised interest rates by 500 or 600 basis points, because it's really not. It's the bank's fault for screwing up, and that's it.
Bad risk management.
Bad risk management, but we're not going to penalize the best startups in the country, okay, or some of the best startups in the country, because they can't manage their risk.
I agree with everything you're saying. Which leaves me with the innocent victims now that we've moved from two kinds of banks, which we had two kinds of banks before this happened. And after this recent intervention, we now have three kinds of banks, as I just described, right? And if you're in category 3, you, sir, are screwed, I think would be the word. and that is anybody who's not one of the big four and who was not sponsored like the first banks that failed here. So it's all the names that everybody's been blathering about the past few days. First Republic is a headliner. I mentioned Western Alliance. You can kind of go. There's a list, right? The regional banks. I mean, I haven't looked at PNC. They're bigger, but or U.S. Bancorp. I think you have to do something for that third category here,
Yeah, I agree.
or you're sealing their fate.
Yeah, I agree.
Basically.
I agree. And anybody that's ever used small regional banks, I mean, they're awesome, for the purpose that they serve.
Yeah.
I mean, the last place you want to, try going.
First Republic is a great bank in New York. Everybody loves it, right? I mean, whatever. I mean, anyway.
Try going into JP Morgan and ask him about a mortgage.
Right. Yeah.
Good luck.
But my point is, right now you've created a death spiral. I don't know if it's a death spiral because I actually don't think these banks are going to go away.
No, they're not.
But the incentive to take your deposits out of that third tier. I mean, the best bank you could possibly move your money to right now is Silicon Valley Bank, by the way. Right?
Well, no, they're not even open.
Sponsored.
But they're not open.
You get my point. Or but like that moving money into JP Morgan or a sponsored bank, you've created an incentive to abandon all of the regional banks.
Yeah, it's definitely not their finest day.
Are you trading them?
The regional banks, not really. They're not really tradable. So to be fair, I did this hit on another network yesterday, and they said, "Are you trading the regional banks?" And I'm like, "No. I mean, I don't really even. None of them trade enough. They don't really have options. They're."
I mean, First Republic has options.
Yeah, I know, but they're kind of trade by appointment. The other day, the options in First Republic were so wide we couldn't trade them. It's not. Yeah, you could try to trade them today. I would say no. I'm not trading those, but we are trading everything else.
The other thing, because I was thinking about you, when I was walking today, the opportunity to sell volatility has to be sensational.
Well, yeah, and today was even crazier because we had vol up, actually the market just rallied a little bit. So vol sold off a little. It's still up almost 10% of the day, but it was up, almost 15 or 17% at one point today. Yeah, the vol has been out of control this week, and it's incredibly strange going into triple witching, going into everything else that's going on. Very weird.
Any standouts for you?
No, actually, it's been
across the board.
No standouts. I mean, we haven't. I would like to say that we've had a good week, but we haven't. We haven't had a bad week either. It's been an absolute nothing. We've had some big swings every single day. On the vol contraction days like yesterday, we did great, and on the vol expansion days like today, we did crappy. So we really been just at the mercy of volatility. The best trade we've had on is the yield curve trade, which I think this is a transformational bottom in that. I do not think you're going to see the 2-year and the 10-year ever close to that 100 basis points again. And I thought that was an extreme trade of the century type thing. I don't think it's there anymore. But I think this is a really good indication that trading is going to be, when you least expect it. And also, this is why we trade, because in my heart, I know that if the CEO of Silicon Valley Bank traded a one-lot yield curve trade using CME futures, that they never would have gone to that extended duration. Like a one-lot,
because his awareness of what duration means would be completely.
I actually don't believe that these people these CEOs that manage these companies that are pure salesmen, that's all they are, salesmen. I don't believe that they really understand the magnitude of the trades that they're making and the risk in the trades that they're making. If you had a one lot on and you rode that one lot for $15,000 against you, literally that's what the yield curve did. Moved $15,000 on a one lot. On a one lot where the volatility would suggest that wouldn't happen once every 100 years. And I think if you had that position on just one time, that Silicon Valley Bank would still be worth $100 billion. And I believe that.
Because they never would have put on that level of duration because they would have actually understood how
exactly. And the same thing for Bear Stearns, the same thing for Lehman Brothers, the same thing. Like if anybody was trading any of those, swaps back in 2008, 2009, or if any of these people that run these places had any idea what it's like to see the minuscule size and how much these things move, they never would have had on the billions of dollars that they put into this stuff. They never would have had on a fraction of it. So
I agree with you. Okay. I forgot. There's another solution to moral hazard that I want to bring back in here, which would be a regulatory change, which may have a number of other issues. But when the banks were partnerships, not publicly, where there was no public stock.
Sure.
So the risk doesn't get transferred out to third-party shareholders or third-party bondholders, but the risk lives within the partnership. And so the same way you're talking about, if you're exposed personally to the experience of a one-lot risk, then you have a much better comprehension of the totality of the risk in your portfolio. If you are in a partnership where the only thing at risk is your personal net worth, not your pension fund shareholders or your sort of CalPERS bondholders, I think that also very much changes how risk is managed.
Do you know why Ken Griffith can come out and say it's a moral hazard?
Because he's owner operated.
Because he deals with this every day, bigger than an exchange, and he basically puts his nuts on the line every single day to the extent of billions of dollars, and it's his money basically. And so
it's a partnership.
Right, it's a partnership. So he's clear of the concept of risk, but he's also not the CEO of a major bank. They don't think that. That's not how you've been around.
But imagine a regulatory change that says you can't.
That's right. That's right.
You want to be that's some percentage, 60, a huge material percentage of the equity needs to reside with the owners.
Or they have to have the experience. But my experience with financial service companies, after being bought out by TD, IG, whatever, and then all the other companies that we've dealt with throughout the years, the CEOs of companies throughout the entire industry, okay, they don't trade.
And their sales, that they got the job through excelling at sales or the ability to bring a rainmaker role of some sort.
Schwab is up $2.50 today. You know why? Because for the first time in like 20 years, Walt Bettinger, who's the CEO of Schwab, actually went on CNBC to stop the bleeding and said, I'll buy 3 million shares of my own stock. $3 million worth, I think.
Yeah, 50,000 shares.
Yeah, 50,000 shares. Big freaking deal. The guy's made $2 billion on this. He buys 50,000 shares, whatever. But my point is, and he hasn't been on CNBC in 20 years, but to stop the bleeding, that's what he had to do. And in fact, I'll tell you a little story. The other day, they called me up and they said, hey, can you come on? But I said, they want to ask a question about Schwab. And I said, why don't you just get Walt Bettinger to come on? Better him. He goes, well, he won't come on. And I go, well, why won't he come on? He goes, because he hasn't been on in 20 years. He won't come on the network. And I go, well, why would you ask me a question about Schwab? That's not fair to me. I'm a competitor. I don't really care. I don't know anything about them. You got to ask him. You go, well, if he would come on, we would ask him, but he won't come on. Next day he comes on. Because you know what? That's how do you stop the bleeding? You come on and you buy the stock and then everybody goes, oh, it's real, finally.
And so I would say that the combination of accounting changes and forced retained risk to the leadership are probably the two greatest solutions to moral hazard.
And there's one more solution. If you want to be the CEO, okay, and you have access to material non-public information, like we are sitting on a $20 billion unrealized loss, I don't care if you have planned sales or not, you cannot sell your stock.
Well, I do think I think there'll be a penalty for them. I think that will come back to bite them.
That's fraud. That's fraud. Yeah. That's insider sales. That's fraud, whatever you want to call it. I mean, Martha Stewart went to jail for selling 2,000 shares of
on something that might be true. I mean, that was the whole. I mean,
Whatever,
anyway.
whatever. I mean, and yet this guy, can take down $100 billion company, knowing exactly, she probably heard it through. What? I don't know. I don't know the story. I don't really care.
Sam Waxman. I remember it was Sam Waxman was a biotech CEO buddy of hers that told her, whatever, some like
Yeah, I know.
ruling or something, whatever.
But it's so ridiculous. You know how ridiculous that is. And it's time that,
That was a witch hunt, but we don't have to go back to that.
No, I know. But, you have to understand what we deal with with the current regulatory environment right now. We can't get the regulators to provide any clarity around, around crypto. We can't get the regulators. The securities regulators are trying to change the tick size. Gary Gensler wrote a 1,600-page document to address tick size, to get rid of payment for order flow, a system that works, to deal with pattern day traders, which is the most ridiculous rule ever. Like, none of that stuff. We can't even get them to even address it, let alone change anything. And now they're gonna, yeah. I just.
Well, I mean, yeah. I mean, because I'll even extend it further, not to gripe forever about the regulators, which is also low-hanging fruit, but the simplest changes are the most effective regulations, whether it's a retained risk requirement in management or whether it's an accounting change. These are the sorts of things, especially the retained risk piece. These are the sorts of regulations that can be passed on 1 or 2 pages. And the politicians prefer 3,000 pages of line-by-line rules and waivers and loopholes and bullshit that, the politicians are the problem as much as the leadership. Not that is a great insight on my part, but the illusion is that we don't know what to do, or how could you possibly solve this when every owner-operated business in the world solves this every day by virtue of the consequences of bad risk management when you're not managing someone else's assets, whether you're a CEO holding shareholder or bondholder money, or whether you're a hedge fund manager. There's a different mentality. You're more risk seeking and less risk averse than if you're Ken Griffin or an owner operator for a bagel stand.
That's right.
And which is kind of your point, which is buy a one tick, because now it's your money. It doesn't even have to be a multi-billion-dollar thing. You can be a $15,000 thing, and you'll believe me, you'll understand what's happening. Anyway, do you have a sense of whether you think this will continue to spiral? In other words, obviously today's a lousy day, whatever. It's a garbage week here. Are you concerned about a broader, more catastrophic decline in stock prices as a result of any of this?
I'm not.
Yeah.
I mean, don't forget, we're not starting if we were at 4,800 in the S&Ps and we were having this conversation about what happened this week, I think I would be very concerned. But we're at 3,800. So, I'm not nearly as concerned as I would be, if we were 20% higher in the stock market. So at these levels right here, is there downside risk? Of course. But is it the kind of thing where I think we're pretty good right here? I think this is actually a little bit healthy. I think we're good.
Which, by the way, might be a bad sign. I think we're good too, but maybe anyway, to Tony's point on Sunday, nothing bad happens when you're expecting it. So if everybody's feeling, so that there's an irony in that.
Yeah, of course. All right, Mr. Radigan, that was good. What time is it? It's about 1:46. Perfect. We're right about the end of our session. Any final words, or we will?
I mean, listen, I've always been a big clawback guy.
Yeah, I don't like the clawback.
But I thought you kind of gave me food for thought, because your point is, why do the associated individual, the Israel, why do the kids have to pay because the old man's a fool? And I think there's a reasonable truth there.
We used to have a rule with private equity firms where we raise money. Rule number 1, no earnouts. I hate earnouts. They don't make any sense to me. Rule number 2, no clawbacks. So for my entire career, I have lived with a third rule, which is no NDAs.
Really? Okay.
Nothing bothers me more than when somebody hands you an NDA. And do you know what our response is when somebody gives you an NDA? It's the same response that Apple had all the time is, we own every idea. And so do you. And so does the next person. So if you don't want to tell me, don't tell me. But you're not getting an NDA. So no NDAs, no callbacks.
No NDAs, no clawbacks, no earnouts.
And no earnouts, because earnouts are too manipulative. They don't work. But, you need some rules. And those were 3 of ours. Oh, yeah, the 4th one, no high fives.
No high fives?
No high fives.
Fist bumps?
Fist bumps, we never, they're relatively new.
They didn't exist.
Yeah,
But would they have been banned if they were popular?
High fives were banned. High fives
Why?
are banned because high fives are, that's usually a top.
Self-congratulatory.
Right. I once did a talk, and the title of the talk was No High Fives. So
I like it. I like it. I can abide by all of those.
yeah, I thought you could.
Yeah,
Anyway,
abide
I'm
by
Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. Please join us every Wednesday, 1 p.m. Central Time. Next Wednesday, Dylan, the Fed's coming out again at 1 p.m., so we're going to have a little fireworks when we come on, but I will see you next Wednesday.
All right, I'll see you soon.
Ciao.
Bye-bye.